Well, as our buddy Yogi Berra said, it's deja vu all over again. 5 years ago this weekend, the financial meltdown, it hit when investment bank Lehman Brothers went bankrupt as a housing bubble blew up. Now, many blaming that bubble on the Federal Reserve for keeping interest rates artificially too low for too long. But the Fed has been at it again, keeping interest rates artificially low with a stimulus plan that's on steroids. Could that be causing another bubble that's about to blow up? This time, the stock market itself. Sabrina, what do you think?
I do think that we are at risk for a bubble, but part of the problem is that people don't know where to put their money, right? They don't know, should they invest it in real estate? Should they invest it in the stock market? And when you see the stock market close 140 points up like it did on Monday, there's a real tendency to jump in. But I think that there's a sort of false sense of security in terms of the business market today. You see places like Neiman Marcus being bought for $6 billion or Koch Industries buying Molex for $7 billion, and people think everything's okay, and they're not thinking about the fact that Obamacare is going to be implemented in a few months, and this is going to wreak havoc on the economy. Well, so I do think that people should be cautionary.
John Tamny, if we believe that Greenspan caused a bubble by keeping interest rates artificially low, what does Bernanke do? I mean, he is Greenspan on steroids. Greenspan didn't keep interest rates at zero. He wasn't buying up government debt the way Bernanke is.
Well, you know, when you think of quantitative easing, it is a horrifying perversion of money that robs it of its sole purpose.
Let me just define it for audience members that might not know. That essentially means printing up a lot of phony money in order to buy government debt. Go ahead.
Real money.
Yeah, and so that I don't think could be driving a stock market bubble. If anything, it's restraining it. I mean, we've got to remember that when investors invest in the stock market, they are buying future dollars. Quantitative easing is an explicit devaluation of the dollars. And so the better question to ask is, if the Fed weren't meddling like this and holding our economy back, how much higher would the stock market be? The Fed is the problem, not the driver of any stock market bubble.
But, Emac, the fact is that older folks who are afraid to play the stock market, they don't have anything to do with the money. Because now if you put it in a bank account, you're losing money because inflation.
Yeah, that's right. And boy, you need a microscope to look at those returns, right? Because they're basically so small. But, you know, to John's point, I mean, even if the money that they sock away, it's going to get devalued because the dollar is dropping and it's going to get hurt. And that's like changing the number of ounces in a pound, right, when the dollar gets hurt like that. And the problem is the Fed has been in this permanent state of emergency. It's like this economic hypochondria. They are printing money like Vegas drunks and the government's spending money like Vegas drunks. But I'm not sure the stock market is in a bubble. It's still trading on a PE basis at half of what it was in the dot-com era, David.
Rich, I don't know about that. I mean, I know that a lot of folks don't think the stock market is a bubble, but most of those folks are people making money off of it.
Yeah, I think Emac is right. I think it's roughly fairly valued, maybe slightly overvalued right now. But it's compared to what? You know, the emerging market economies, which were the stars of the international stock markets for years, are really suffering. Their currencies are really dropping fast, and capital is leaving those countries. Interest rates, as you pointed out, are very low. So we have, what do we have left? We have the American stock market. Profits are still high. I'm always wary of September and October. You know, history says these are, you know, outsized volatile months. But I don't think I would either pour new money in nor would I get out.
But Sabrina, the fact is that, again, getting back to folks who want to save money, if you try to save money, if you're afraid to put it in the stock market, if you're saving it by putting it in the bank, you're losing money right now. The savers are getting killed, the people most vulnerable.
Yeah, and I just think that I'm always a little bit cautious when there's a lot of enthusiasm. I mean, remember Jim Glassman and Kevin Hassett talking about Dow 36,000? Well, we're not quite there yet, but when everyone jumps on the bandwagon, I think it's a time to say, well, maybe let's just see, maybe this is not the thing for me.
Bill, are these artificial low rates pushing people into the stock market?
The Fed has always been playing a game called asset bubble, and the game works like this. You give people the illusion of wealth by repricing their houses higher and making their stock go up, even though the houses aren't any bigger than they were before, and even though the companies they're investing in aren't any more productive than they were. Now, this bubble works to a modest degree. I think stocks are overpriced, but maybe by 15%.
But earnings
And
are
under
going up.
Greenspan, Mr. Real Bubble, they were overpriced by 100%. So it worked bigger back
But
then.
wait a minute, Rick. The fact is that Bernanke's doing a lot more to cheapen our dollar than Greenspan was, right? I mean, he's bringing the interest rates down to zero. At least Greenspan had them at 1%.
Yeah, they existed in different times. But more importantly, I don't know why you guys aren't talking about the fact that corporate profits have been good. Isn't that why the stock market's good?
No, because the reason they've been good is because they've been firing people. That's why the unemployment rate has been high.
That is true, but they're making money overseas,
A
too.
fortune.
Yeah.
I don't know.
They're not. Hold on a second, Sabrina. This is an important point. The revenue coming in. That's not why the profits are increasing. It's because these corporations are squeezing their operations.
Yeah, and this is why I think we have to be, cautious because look, Obamacare is about to go into full effect in January. I mean, this is going to cause tremendous strain on the economy and on businesses individually. So while people might see some big headlines that excite them, I think that they don't realize just what's in store for 2014.
We got to go. By the way, Rick, you're laughing at Obamacare. It's keeping a lot of business people up at night.
And I hear that Obamacare is responsible for Syria.
Big impact on our business
And Vietnam.
community. We got to leave it at
And
that.
World War II.
Check this out. A billboard sign from a conservative group claiming the health care law is hazardous to your health. Well, did grocery store chain Trader Joe's just prove it right? That's at the bottom of the hour on Cashing In. But first, right here on Forbes, one U.S. city trying to help housing by seizing home mortgages worth more than the house. But isn't the best thing for housing to just leave them be? That story coming next. A so-called fix for housing that some here say will just make it worse. City council members in Richmond, California, passing a plan to seize underwater mortgages. These are loans that are worth more than the actual house. They say this will keep people in their homes and help home values. A number of other cities across the nation are considering doing the same thing. But, Rich, you say this is all going to backfire. How?
Well, Richmond gets its ideas from its neighbor Berkeley, which is Havana on the Bay, and this is a foolish idea. You can't have, the only way you get a real market recovery is when you let prices drop to their natural level. And there's plenty of money in the Bay Area that would invest in real estate if it found its natural low price.
So, Rick, this is one of those pie-in-the-sky ideas. It sounds good, but it's not going to work.
Well, actually, I think Rich is right. Berkeley, they do get their ideas from Berkeley, and let's face it, there's not too many towns or cities across the country that are like Berkeley. It's 100,000 people. I don't think we're in any danger of this catching on. It's not going to have an impact.
But, Emac, there are some other cities that are following suit.
Oh, yeah, no kidding. This is magical science fiction thinking on the part of this very poor city that taxpayers are going to now have to foot the bill for this really bad policy, David. And I'll tell you something, Democrats rejected this idea in Congress. A lot of Democrats said, no, don't do this. You know why? Litigation, lawsuits are going to hit the city, and also banks will never lend to anyone in that city again because of this really bad policy.
And, John, we were talking before about what America is perceived as. Our self-perceptions are important. The people who are paying the bills are not rewarded. It's the people who aren't paying the bills who are rewarded, right?
Oh, it's such a bad signal. It tells the irresponsible in this country, go buy a house you can't afford because you will be subsidized by the prudent who don't buy that which they can't afford. It's terrible for housing, and it will drive away investors from the sink of wealth as housing. That'd probably be a good thing, but let's not do it.
Sabrina, will it help or hurt the housing problem?
It will ultimately hurt. Look, I can sympathize with the mayors and the city councils in places like Richmond, California, or Stockton, because the fact is when you have an increase in foreclosures, you have an increase in abandoned homes, an increase in decay and crime. These are real problems for cities, but the fact is we have to stop bailing people out. We have to stop propping things up. We have to stop buying. This is a fool's errand. We have to let the prices fall to their market value.
On the other hand, Bill, nobody likes the bankers, and people say, okay, they're the only ones that'll suffer here.
Yeah, but the bankers do own these mortgages. So this is how it's structured. The politicians are seizing private property at gunpoint and handing it to their friends. Now, this will work exactly as well as it worked in the economy of Zimbabwe.
All right, so if you like Zimbabwe, you got to love this plan. Coming up, some investors and consumers disappointed.